Welcome back to our channel, where we analyze the strategies of big companies to learn from their successes and their failures. Today, we're going to talk about a company you surely know. Crocs. But, did you know that this company, despite its popularity, closed all of its own factories? Stay with us, because I'll tell you why they did it and how they're managing to survive and thrive in such a competitive market. Crocs was founded in 2002, and quickly gained notoriety, with its unique shoes made of a patented resin called Croslite. This material is known for being lightweight, comfortable, and having antibacterial properties, which made the footwear stand out. Since its inception, Crocs has sold over 800 million pairs of shoes worldwide, becoming a global phenomenon. In 2006, Crocs sales skyrocketed thanks to its unexpected popularity. Celebrities and influencers began wearing the shoes, and although many criticized their appearance, this very controversy helped boost their visibility. Crocs went from being a niche product to becoming a global trend. During this period, Crocs opened hundreds of stores and factories to meet the growing demand. But as often happens with trends, what goes up must come down. In 2008, coinciding with the global financial crisis, Crocs sales began to decline rapidly. The market was changing, and demand for its quirky shoes started to wane. The company found itself in a critical situation. It had grown too fast, investing in a massive infrastructure of stores and factories, and now faced the challenge of managing a cost structure that was disproportionately high for the actual demand. They tried to react quickly, launching new designs and collaborations with celebrities. But sales remained volatile. Crocs realized it was too dependent on being in fashion to keep its business afloat. Starting in 2013, Crocs made a strategic decision to begin closing physical stores and reduce its direct presence in the market. The goal was to cut operational costs and simplify its business model. Gradually, they started closing their physical stores. Of the more than 500 stores they owned, only a few remain today. The next step was even more radical: closing all of their own factories. But this did not mean the end of Crocs, but rather a new beginning. Instead of producing internally, Crocs decided to outsource its production. Although they lost some control over the process, they managed to significantly reduce fixed operating costs, allowing them to have a much more flexible and adaptive structure. To stay relevant, Crocs adopted an aggressive marketing and collaboration strategy. They partnered with celebrities like Drew Barrymore, John Cena, and Justin Bieber, and collaborated with designers to launch limited editions that revitalized their market image. Crocs also appeared on runways and fashion events, proving that they could be both a fashion product and a functional product. They also found a stable market in sectors like healthcare and hospitality, where their shoes are valued for their comfort, durability, and antibacterial properties. This allowed them to obtain more predictable income that was less dependent on passing trends. And this strategy has paid off. During the COVID-19 pandemic, Crocs experienced a remarkable increase in sales due to the shift in consumer preference toward comfortable and casual footwear, while working from home or limiting outings. In 2021, Crocs reported significant revenue growth of between 62% and 65% compared to $1.39 billion in revenue in 2020. This was driven by the popularity of its products and strong growth in the digital channel, which accounted for 36.8% of its sales in the third quarter of 2021. In 2021, Crocs reported record revenue of $2.3 billion, an increase of 67% from the previous year. In December 2021, Crocs announced the acquisition of Hey Dude, a brand of casual and lightweight footwear, for a total of $2.5 billion. The transaction included $2.05 billion in cash and $400 million in Crocs shares. This acquisition was completed in the first quarter of 2022, and Hey Dude is expected to operate as an independent division within Crocs. The purchase aims to diversify Crocs' portfolio and enhance its digital penetration, as Hey Dude generates 43% of its sales online. Following the acquisition, Crocs expects Hey Dude to generate approximately $570 million in revenue in 2021, with a goal of reaching $1 billion by 2024. Crocs projects to achieve $5 billion in sales by 2026, with a compound annual growth rate of more than 17% over the next 5 years. The company also plans for at least 50% of its revenue to come from digital channels by the end of 2026. Crocs stock has shown remarkable recovery and growth. During 2021, the shares rose by 97.1%, significantly outperforming the 7.3% growth of the footwear industry. This increase is attributed to the rise in demand for casual footwear during the pandemic and aggressive expansion and diversification strategies, such as the purchase of Hey Dude. This is a valuable lesson in how a company can adapt and thrive in a challenging and changing market environment. So, what can we learn from Crocs? Here are 3 key lessons. Flexibility and adaptation. Crocs wasn't afraid to radically change its business model when necessary, adapting to new market circumstances. Understanding trends. It's crucial not to rely solely on trends. Diversifying both products and target markets is essential for stable and sustainable revenue. Cost reduction and digital focus. Maintaining a controlled cost structure and leveraging e-commerce to the fullest can provide a company with the agility needed to face changes in demand. Crocs has proven to be a resilient company, learning to adapt and capitalize on trends without depending exclusively on them. This is how Crocs has managed to stay competitive and continue to thrive in the market. If you enjoyed this video, don't forget to subscribe, like, and hit the bell for more business strategy analysis. And tell me in the comments, what do you think about Crocs' strategy? Do you think they made the right decisions? We love reading your opinions. See you in the next video.